Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cooper Standard Holdings Inc. Annual Report. Cooper Standard Holdings Inc. offers a diverse range of businesses and services through its subsidiary. The company's primary products include sealing systems, fuel and brake delivery systems, and fluid transfer systems. Sealing systems comprise metal, plastic or wire carrier seals, rubber, silicone, and plastic sheeting, as well as molded seals and gaskets made from various materials. In addition to sealing systems, the company provides fuel and brake delivery systems, including bundles, fuel rail technology, fuel and vapor lines, metallic brake and tank lines. These products are designed for optimal thermal management, powertrain and HVAC operation in passenger vehicles and light trucks. The company also offers fluid transfer systems, which include air intake and charge air hoses, brake and clutch hoses, diesel particulate filter and SCR emissions lines, heater and coolant, secondary air, and transmission oil cooling hoses. These products enable the sense, delivery, connection, and control of fluid delivery for optimal performance in vehicles. Furthermore, Cooper Standard Holdings Inc. exports rubber, silicone, plastics, and select metals to various regions around the world. The company's products are primarily used by automotive original equipment manufacturers and replacement markets. With a rich history dating back to 1960, Cooper Standard Holdings Inc. has established itself as a leading provider of innovative solutions for the automotive industry. The stock price of Cooper Standard Holdings Inc. has skyrocketed by over 181.8% in the past year due to a combination of factors. One key event that triggered a significant surge was the company's strong full-year 2025 financial results, which showed improved adjusted EBITDA and net loss compared to the previous year. The company also reported positive free cash flow for the first time. A major driver of investor optimism has been Cooper Standard's strategic shift towards electric vehicle programs and its expansion efforts in the Chinese market. In 2025, 74% of the company's new business awards were related to battery electric or hybrid vehicles, with 51% of these awards coming from Chinese OEM customers. This strategic alignment with high-growth segments has resonated positively with investors. The company's optimistic 2026 guidance and double-digit EBITDA margin target have further boosted investor confidence. Cooper Standard projected sales between $2.7 billion and $2.9 billion, and adjusted EBITDA between $260 million and $300 million for the full year, suggesting continued profitability and margin expansion. The company also secured significant new business awards in 2025, totaling $298 million. The immediate surge on February 13, 2026, following the earnings release, contributed to the substantial year-over-year growth, with the stock reaching a new 52-week high of $43.34. Overall, investor confidence in Cooper Standard's strategic direction, improved financial health, and positive future outlook has driven the significant increase in its stock price over the past year. Cooper Standard Holdings Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Cooper Standard Holdings Inc. trades at a higher price-to-earnings ratio of 24 times and a lower price-to-book ratio of -9.55 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 108% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for Cooper Standard can be categorized into several key areas. Firstly, sales to original equipment manufacturers, OEMs, and organic growth through strategic acquisitions have been significant contributors to revenue growth. The company's expansion into new markets, such as China, and its focus on providing value-add solutions for electric vehicles and hybrid options have also driven growth. In addition, Cooper Standard's adoption of artificial intelligence, AI-based tools has supported polymer compound development, while industry recognition and awards for the company's innovations have further boosted revenue. The increasing demand for AI technologies across various functions has also contributed to growth. On the other hand, the primary drivers of revenue decline include raw material prices and availability, seasonality in automotive production, supply chain challenges, and changes in consumer demand and broader economic conditions. Unfavorable volume/mix, unfavorable foreign exchange, commodity prices, pricing pressures, and commercial adjustments have also negatively impacted revenue. It is worth noting that while these factors are significant drivers of revenue growth or decline, they can be influenced by various external and internal factors, such as changes in tax laws and rates, currency fluctuations, impairment charges, and pension plan underfunding. The net income of the company experienced fluctuations throughout the year, resulting from various factors. Initially, it decreased due to uncertainty in realizing sales from awarded business, pricing pressures, and loss of major customers. This trend continued as debt service obligations increased, leading to higher interest expenses. However, a significant increase was observed when a net income tax benefit was recognized. Profit margins also underwent changes, primarily driven by cost-related factors. The decrease in profit margins was attributed to increased raw material costs, difficulty passing through these costs to customers, and higher interest expenses from variable rate debt. Conversely, an increase in gross profit margin led to a 0.8% rise in profit margins, while operating income margin also saw a 0.6% increase. The reasons behind these changes were multifaceted. Inflationary pressures and seasonality played a significant role, as did tariffs, trade restrictions, inflation, and decreased demand. Additionally, uncertainty in sales realization, pricing pressures, competition, and failure to realize cost savings contributed to the decline in profit margins. The impact of idle assets and changes in economic or operating conditions also affected the company's financial performance. The company's financial performance indicates a positive trend in its operating cash flow. On page 1 of the report, it is stated that the net cash provided by operating activities for the year 2025 was a substantial $1,456 million. This figure suggests a strong ability to generate cash from core business operations. However, upon closer inspection, there are discrepancies in the reported figures across different pages. On page 34, it is mentioned that the net cash provided by operating activities for 2025 was only $64.4 million. Furthermore, on page 55, the figure is listed as a positive $64,442. These inconsistencies raise questions about the accuracy of the reported data. Despite these discrepancies, the overall indication from the report is that the company is generating positive operating cash flow. The large figure on page 1 suggests a strong financial performance, although the smaller figures on pages 34 and 55 may indicate some anomalies in the reporting process. The company's debt level has experienced significant changes over the past few years. According to the extracted summaries, the total indebtedness of the company increased from $178,697 in 2024 to $199,882 in 2025, indicating a rise in debt level. Furthermore, the debt payable within 1 year also saw a substantial increase of 102% from $42,428 in 2023 to $86,121 in 2025. In terms of interest expenses, there are mixed signals. While interest expenses increased by $24,806 for Sealing Systems, page 34, they decreased overall from 2024 to 2025 by -$1,063, page 44. Additionally, the net cash used in financing activities decreased from $9.6 million to $4 million, suggesting a potential decrease in interest expenses. Overall, it appears that the company's debt level has increased significantly, while interest expenses have shown mixed results. However, the overall trend suggests a decrease in interest expenses from 2024 to 2025. The performance of the company's segments varied significantly over the period of 2023-2025. The Sealing Systems segment stood out as a strong performer, with revenue increasing by $48 million and adjusted EBITDA rising by $21.4 million. This growth demonstrates the segment's ability to adapt and thrive in its market. In contrast, the Fluid Handling Systems segment struggled, experiencing a decline in both revenue and adjusted EBITDA. Revenue decreased by $17.7 million, while adjusted EBITDA fell by $5 million. These disappointing results highlight the need for improvement in this area. Management is emphasizing innovation and sustainability as key drivers for the company's growth and success. The company will continue to leverage technology, materials science, and digital tools to drive innovation and improve efficiency. A focus on corporate responsibility through its Global Sustainability Council is also a priority. The company is expanding into new markets by leveraging pre-existing infrastructure and local partners. However, management notes that there are risks associated with acquisitions and divestitures, as well as the potential negative impact of substantial debt on the company's financial condition. Management expects challenges in 2026 due to industry production levels, raw material costs, and global trade policies. To mitigate these risks, the company is actively preserving cash and enhancing liquidity by proactively managing capital expenditures and continuously monitoring its liquidity situation. In terms of long-term growth, management has a strategy focused on developing internal budgets and forecasts using EBITDA and adjusted EBITDA metrics. This will enable the company to evaluate potential acquisitions and compare current operating results with historical periods and industry peers. The company has made several strategic acquisitions and divestitures in recent years. On the acquisition side, the company purchased Lauren Manufacturing and Lauren Plastics in 2018, expanding its capabilities and presence in the market. Additionally, it acquired a Canadian tooling business and a building and land related to one of its Canadian facilities. In terms of divestitures, the company has sold off several businesses, including its European technical rubber products business and a joint venture in the Asia-Pacific region. These moves are likely aimed at streamlining operations and focusing on core areas of growth. The designation of Liveline Technologies, Inc., as an unrestricted subsidiary in 2023 is also notable, although it does not involve the sale or transfer of assets. The financial impact of these divestitures can be seen in the company's gain on sale of businesses, which was -$586,000 in 2023 and -$1,971,000 in 2024. These figures suggest that the company may have taken a loss on some of its divested businesses, but it is also possible that the sales were strategic decisions aimed at reducing debt or improving overall financial performance. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done in the past. According to the most reliable source, page 89, the answer to this question is affirmative. The company's commitment to sharing its profits with its investors demonstrates its confidence in its financial performance. In addition to dividend payments, the company has also taken steps to return value to its shareholders through share buybacks. This strategy allows the company to reduce its outstanding shares and increase earnings per share, thereby benefiting its investors. With a clear yes on page 90, it is evident that the company has indeed bought back shares in the past. Concerns about inventory buildup and supply chain disruption. The automotive industry is facing significant challenges in terms of inventory buildup and supply chain disruption. One major concern is the potential for supply chain disruptions due to inflationary pressures on raw materials, abrupt changes in market prices or availability, and prolonged supply chain challenges that have constrained output and limited OEM's ability to rebuild inventory. Furthermore, there are concerns about trade restrictions, tariffs, or taxes on imports from countries where products are manufactured or raw materials are sourced. This can lead to increased costs and reduced availability of raw materials and manufactured components, ultimately affecting profitability. In addition to supply chain disruptions, the industry is also experiencing inventory buildup. Rising inventory levels in 2025 led to a slowdown in light vehicle production, while finished goods inventory, work-in-process inventory, and raw materials and supplies inventory all saw significant increases from 2024 to 2025. These trends suggest that the automotive industry may be struggling with inventory management, which can have far-reaching consequences for manufacturers and suppliers alike. Overall, these concerns highlight the need for the automotive industry to address its supply chain and inventory management challenges in order to maintain profitability and competitiveness. That concludes the financial summary for Cooper Standard Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.